Well, good morning and happy Thursday. I mean, here we are, and my quote is going to be perfect for the season. So, as Megan gets us kicked off on Facebook, I'm going to start off with a quote, but first, I'm going to say thank you for an incredible 3 years.
It has been 3 years. I've put this report together 200 times.
200 times.
200 times.
So, this is like a celebration.
This is
yes.
Of being ludicrous in the marketplace.
It's been a roller coaster. I don't even know where to start. If somebody said, how have the last 3 years been? Where do you start?
It feels like a blur to me.
It does me too. And I can't, there's no time.
No.
Like I'll tell somebody, yeah, that just happened a couple months ago. And they were like, that was 9 months ago. And I'm like, it's all the same.
Yeah.
It's all the same.
No.
Within the last 3 years, it's all the same. So, as we get going on this next phase, right, everybody has a decision to make. And I'm actually I'm going to put this back on you guys, because as we're going down these separate paths, starting tomorrow, next week, right?
Next week.
So, you guys have heard the news that Megan is venturing out on her own due to the reports and the structure. And I know that she's mentioned that a number of times. But that opportunity, remember that when a door closes, another door opens. And right now, it feels like that there might be some doors closing. I was talking to a good friend of mine, and they were like, nobody's calling me.
I'm like, I my email so quiet. Oh God. Oh God.
But I think about this, and all I think about is the opportunity, and it excites me. Like I'm so excited to do business in this market.
Yes.
And that makes me a little nuts.
Maybe. I know. Well,
maybe.
I mean, it's like I like to do the hard stuff.
Yes.
Like I want it because I know that other people are going to fall off the radar and they're not going to do it. Whereas I'm gonna really grit down and I'm going to go for it.
Yes.
And this market is not going to get me down.
This market is challenging, and it's opportunities within the challenge. There are winners in every market. We have to find them. We have to find the people who desperately need to find that deal. We know that the fourth quarter, really of any year, presents opportunities, but that certainly the fourth quarter of this year, which I know that you're going to talk about during the real estate half, we're going to be talking about the numbers and how it presents opportunities. And on the back half, I've got some data that's going to shock you. The economy is still resilient, but what doors do those open for you in this market? Because there are so many opportunities for conversations right now. I don't know that you could go to the party, you can go to a party, a holiday party, or you go to the grocery store without somebody going, what is going on in real estate?
Yeah.
Bam, door open.
We're all talking about it.
All talking about it.
All the time.
So here goes. Here's my quote for today. And suddenly, it's time to start something new and trust the magic of beginnings. I love the thought of that. I love the thought of that, because every end is the beginning of something new. And I know that Megan has talked a lot about what she's going to be doing, and I haven't really. And I'm still enrolling it, and I'm really excited about some of the conversations that are happening.
You're having such good content put out there right now. If you're not following her on Facebook, in the Agent Ignite group, you really need to be part of that. It is so cool. It's such good content.
And we're double downing on content that you can share. So Consumer Direct right now is just an open book for first-time home buyers. They don't feel it. They don't know it. They're scared because the headlines are saying, and you think you can afford a home. And your job is to come in like Superman and say, yes, you can. So that is our job right now. And that's what we're doing with the content. In addition to other events that we've already got working up. So with that, how are you doing?
I'm good. Yeah, I'm good. So we have talked a little bit, and just to reiterate, there are some new people that were on here today. We had an overwhelming number of people that ended up registering for today's webinar. And so for those of you that haven't been following along for the last couple of weeks, I got into a compliance issue with putting this together along with Nicole. Yeah. And so compliance has come down on me, and I have to go off on my own starting next week to do your Thursday market updates. And I still intend to do those going forward. I just have to do those on a solo benefit. Right. Now, to add in an extra layer on top of that, there was a rule change at the MLS that happened about a year ago. And I started talks with them about a year ago regarding this rule change, because it impacts the way that I access the data in order to put this together for you. In short, what the rule change was, it changed change the amount of persistent storage that you could have for listings on your own personal device. And it went from being a large number to a very small number, which made me very much so out of compliance with the rules and the regulations of the MLS. And so I sat down with them and had an open conversation with the head of their compliance team over at RE Colorado to discuss how I was accessing the data and what I was doing with it, and how big this project has become with the distribution of 17,000 real estate professionals.
Right.
And so I said, not doing this anymore is really not much of an option, because so many people have come to rely on these reports in order to better advise their buyers and sellers. And so how can we work together to make this a win?
Right.
And so what has happened is I have to be shifted from a Realtor member into a data provider and license the data from them. Unfortunately, that comes at a significantly higher cost in order to continue to do it. And as a title company, I'm not allowed to offset your cost of anything that comes with business that's seen as an inducement. So I'm getting in trouble for doing a lot of inducements right now. And so what I have to do is I have to start charging for the reports. And we're still working on some of the legalese between the contracts between First American Title and RE Colorado, but that's set to roll out in November. And so there will be more information once I have that contract solidified. You will have to log in. I will no longer be emailing out and broadcasting the reports. I will still put together the weekly blurb of the reports so that you can see kind of the highlights of it and a little snapshot of what's happening in the market. But in order to gain access to the full report, you're going to have to go to ignitere.firstam.com and log in to our platform at First American Title in order to purchase and download the reports. Now, we tried to keep the cost reasonable with this because I want this data be accessible by as many people as possible. And so each report is going to cost $10 to download. So hopefully that doesn't break your bank and you still find the value in those reports so that I can go through and continue to put this information together for you guys. And so that's just a little bit of the roadmap that I'm trying to navigate right now. So I'm dealing with lots of attorneys.
Sure.
And lots of new platforms. And so I will have the link to join the new webinar starting next week. Hopefully in the early part of the week, I'll have that out to you guys. And if not, then I'm going to do it through the old platform just so that we can keep things rolling and there's no disruption to getting the data out to you guys. And so hopefully that helps with everything. But in order to gain access to Ignite RE through First American, you have to reach out to your title rep at First American to get invited into the platform. We have to set you up in our database in order to do that. So there is one hoop that you have to jump through in order to get into the system. And so reach out to your rep, ask to be added to Firstam Ignite RE. Again, the website for that is ignitere.firstam.com that you will eventually log into in order to go into the marketing tab to download those statistical reports.
Yep.
Yes.
And you'll be talking more about that next week and on.
Yes.
Fantastic. So, because I know that, and then if you guys are not getting either Megan's emails, make sure to reach out to Megan, or my emails, make sure to reach out to me. You don't want to miss any of the changes of what's happening. Since we're going to be doing it separately, you're going to be getting emails from both of us talking about either new webinars, new content, new events, new opportunities. So make sure to stay plugged in to everything that's happening.
Yes, definitely. Yes. So let's go ahead and hop into the report for this week. I always mess this up. I always mess this up. Okay, sharing that now. Wonderful. And so let's go ahead and go over to seeing it always gets stuck right underneath where I want it from. But this goes over the week of October 18th through the 24th through this last weekend. Keep in mind, I do go through on page 2 of the report and I give you all of the bullet points that you need in order to put out social media content. And what I'm seeing a lot of people do with this is they take it and copy it and paste it directly into ChatGPT and have it write you a 90-second script or a social media post. This is also based off of what I blast out to you guys on a weekly basis for those particular talking points, so that you guys have that embedded right within the email, along with a social media graphic when I follow up with the email from this presentation. And so again, as we look at our strategy sheet from pre-COVID 2019, looking at the strategy sheet, and this is based off of data from 2013 through 2019 in terms of what's happening in our overall marketplace. As you can see, your target list listing month runs across the top in yellow. Your target closing month based off of average days on market and time from contract to closing run across the second row in black. And as the column turns red, the market is heating up. And as the column turns blue, that means that the market is cooling down. And right now we're over here in October. And as you can see, it turns pretty blue as we get into October and November. And so expecting there to be a much slower period as we get into the next couple of months here. And I hope it doesn't turn out like last year did, because last year we ended up, by the time that Christmas rolled around, median days on market for pending transactions was like 61 days. And so looking forward to more time on market as you guys are listing your properties getting into the end of the year. And again, if you have clients that can wait until next spring to list their properties for sale, if we look at the strategy sheet by week for 2023, our hottest week of the year was going back into the weekend directly following Easter. And so your real prime time is that weekend of after President's Day weekend. So looking at that third weekend in February up until about Easter weekend is where the market is really hot. We're shallow on inventory. Buyers are coming out of the woodwork. And that's where the market compresses and where we start to see the most amount of multiple offers that are heading in the marketplace. Our coolest week so far this year has been over Labor Day weekend, but we're starting to shrink back down into that same similar market. Looking here at our overall odds of selling as we get into the later parts of the year, things are really slowing down. Now, again, we've coined this year in 2023 is this is the year that people have to move and not necessarily want to move. And so we're seeing a lot of transactions that are happening right now that are based off of birth, death, divorce, marriage, loss, or change of a job as to why people are moving in the marketplace right now. And what was really interesting to me is I started to pull all of this information together for our market dynamics report and tracking the inflow and the outflow of listing counts and activity in our marketplace was over here checking out our expired and withdrawn transactions. And so last week there were 151 expireds, there were 176 withdrawn transactions. Historically, I end up seeing as we get into the end of September and into October, I end up seeing a lot more historically expired and withdrawn transactions. And so what's happening this year is sellers that are in the market right now really want to sell their house. They're in a position where they have to sell and not necessarily because they want to sell. And they're actually negotiating with you right now. I can't stress to you enough how wonderful of an opportunity it is for a buyer right now to get into the market and to get something under contract with a seller that's willing to negotiate. If you think back over the last 3 years where we were waiving appraisals, we were waiving inspections, we were having earnest money go hard, you were giving up your firstborn child and having to go $50,000 over asking price, $100,000 over asking price in order to win those deals. Right now, you have a great opportunity to come in and negotiate. I did throw out the stat 2 weeks ago where I went through and I did the analysis on concessions and down payment assistance last month. And so in September, it ended up being that 59.7% of all the transactions that closed in September had some sort of concession associated with it. The average concession was $9,000, and 40% of that, 60% of people that ended up having concessions cited that it was for a rate buy down. So keep in mind the 2-1 rate buy downs that you can do in order to get those interest rates down to a point before they can refinance in the next couple of years when we hope that rates will come down in the future. And so don't forget about that option. At the end of the day, if you're thinking about doing a price reduction, if you think about it, a concession or a rate buy down is going to get that buyer a lot further and should be much more incentivizing to them in order to get that rate bought down for the next 2 years. And so I would highly encourage you to consider that. In the MLS, the only way that you can advertise that though is within the public remarks field. And so instead of doing a price decrease, doing a concession or a rate buy down for that borrower to get them into the house to incentivize them for that transaction. But again, expireds and withdrawals are down over 20% this year for the same week than what we saw 1 year ago. So sellers are really sticking in there this year. They have to sell. Our average daily active count this week remained relatively flat at 0.1% up. So we have about 7,000 average daily active units. And I've been hearing a lot of people saying, well, inventory is really high.
Yeah.
And when we go back and we look at 2013 through 2019, historically in October, we have about 9,300 available units for sale. And so inventory is actually shallow from where we were. It's up from where we were from 2020 through 2022, or from 2020, through 2022. But if we look back at 2013 through 2019, where we had a more established normal seasonal market, our inventory is still historically short because the sellers that don't have to sell are simply not selling this year because they're married to that 2 or 3% interest rate.
I mean, I would double click on that with your clients, right? Because it is so much about perspective. So, I mean, we can even have conversations, which I've been having with a lot of folks right now, talking about the fact that from the Great Recession to the pandemic might have been the anomaly. If you go even before that, we can compare to 2012 to 2019, or we can even compare before 2005. And those numbers still, our inventory is low compared to either one of them.
Yeah.
Right. And so we start talking about, well, what is a normal interest rate? What is a normal inventory level? What is a normal days on market? We have to start rethinking that.
Right.
And we can't talk into those conversations to play it off of the last 3 years. That's the worst situation to do.
No, you can't. You absolutely cannot. Looking at our pending transactions, they fell week over week by about 5%, with about 719 units going under contract. Closed transactions were up by about 2.4%, with 606 units going under contract. But overall, our month supply of inventory is growing right now. Month supply of inventory is basically, if no new listings come on the market, how long in months will it take me to sell off the existing inventory? And right now we're sitting at about 2.3 months worth of overall inventory. And that's about as high as it was at the same month 1 year ago. And so it's actually up about 13.6% from where we were 1 year ago. So if that gives us any foreshadowing or what's to come, again, I don't see that big purge of expired and withdrawn transactions leading us into a market where we have that shallow inventory headed into December. Looking at the overall odds of selling, this is where I take into account all of the available listings for sale versus those that go under contract and or close within that 7-day period. And I project it forward for a 30-day period of time to give you the likelihood. If you listed a property last week, what's the likelihood that it's going to go under contract in the next 30-day period? And it's now down to 42.7%. Week over week, that declined by about 0.1%, and versus 1 year ago, that's down by 2.4%. Historically, in October, we usually see about a 48.7% overall odds of selling. When I benchmark that out against 2013 through 2019, so the overall odds of selling headed into the fourth quarter are lower than what we saw. But what's important to note is that our odds of selling were actually higher than the average of 2013 through 2019. When we look at the months of February through June of this year, we actually beat out our baseline of 2013 through 2019. And so it's a little bit slower in the fourth quarter, but we had a much better first half of the year. Even in light of having higher interest rates, that demand was still out there. The real key to this market, why the market is still performing on pace with what we saw from 2013 through 2019, we keep talking about how it's expensive and how affordability has gone down and how much that's impacted our buyer pool, but it also impacted our listing pool as well. And so supply and demand shrunk in relation to each other. And so that means that all of the ratios of month supply of inventory, the odds of selling, close to list price ratios, multiple offers, they're all in line. The number of units that go under contract in the first weekend are still right in line with what our baselines were for 2013 through 2019. And I think we talked about that about 2 weeks ago. So go back and rewatch 2 weeks ago if you missed that webinar about how much we are in line with what we saw from 2013 through 2019. We're still very far from a market and balance. If we were to create that magical 6-month supply of inventory, we need to be closer to around 18,500 available listings for sale. So right now we're sitting at about 37.7% of a balanced market. It's really important that you guys are tracking your show showings right now and setting appropriate expectations for your sellers as to how many showings they should be expecting. And so I get a lot of phone calls after the first weekend that a property was listed that says, Megan, I put up a listing. Here's where it is. This is the zip code. Here's the price range. How many showings should I have expected over this last weekend? And I'm having a lot of sellers come back to me and say, Megan, I didn't get a single showing over my first weekend. And so that is happening out there where you might not be getting as much market activity as what you expect. And unfortunately, as we go through the end of the year, it really does start to slow down. And so last weekend, we ended up putting up about 10,500 total showings were set last weekend. That went up week over week by about 1.1%. So a marginal growth there, but that means that you're getting about 1.5 shows per property per week. So if you're not getting 1.5 shows per property per week, it may be time to consider a price reduction. So it's important that you know how many shows per property per week you should be getting at your zip code and your price range walking into that listing appointment so that you can set appropriate expectations. And if you need help with that, again, all I need is your price point and your zip code, and I can run a report that shows how many showings we're expecting per listing for that information.
And that report is in showing time as
That
well.
report is in showing time. You have to have an updated account in order to go in and get it. But it's a nominal charge and you can run a bunch of different great reports out of showing time. Looking at shows to contracts, again, our showings did go up by 1.1% week over week. That meant that we were looking at about 15 showings to go under contract. So it increased week over week by about one extra showing to go under contract. So again, while more showings were set, it seemed to be more tire kickers. And what I'm hearing most frequently from my buyers and sellers right now, and specifically the buyers that are out there, is that they want a deal. And so they're looking for something that they can walk into instant equity. They want something that is turnkey. They want it to be already renovated because they are buying at the top of their dollar right now. And so it's important that those homes are as ready to go as possible so that the buyer has as little work to come in and do and revamp. So if you have those lime green walls, time to paint them realtor white so that you can get that property under contract. But a little paint carpet will go a really long way to get these properties under contract right now.
And it's certainly, we're seeing buyers come in with contracts where they had to pay at or even over asking, even in this market, for that right home, right? Because they know, I mean, the opportunities we all hope at some point is going to be there to refinance, but either way, those really perfect homes are harder to come by right now. So if that's the home, then I would expect, you know, a little bit, or at least my buyers, I'm telling them, if you find that perfect home, don't try to negotiate as much depending on how many showings that you're having. But then they're looking for the ones that have been sitting on the market 2 or 3 weeks. And it's exactly what you're saying. I have so many investors doing DSCR loans right now, looking for deals. And they don't mind. They don't mind spending the money. They don't mind getting out there.
Definitely.
It's really an incredible market for that.
Definitely. Looking at median days on market for our pending transactions last week, we ended up going up to 23 median days on market. And so that could have been a little bit due to fall break. I know a lot of different school districts have this week or had last week as a fall break going on. And so that could be some of those times. I know I was out of town with my kids last week, which was why I wasn't on the weekly market update. You had Agent Ignite going on last week, but I was up in the mountains with my kids last weekend, doing all the fun things at the YMCA, archery and great stuff.
Love that.
Giving a 6-year-old something pointy to shoot.
A little dangerous, as long as you stand behind them.
There was a lot of help getting the arrow knocked into the bow. Definitely. And so we ended up seeing those 23 median days on market. And looking back to where we were 1 year ago, median days on market is up by 9.5%. So I hope we don't go into the same market that we ended up seeing last year, where we ended up going up to over 60, over 50 median days on market as we ended out the year, but expect the last couple of weeks of 2023 to end up being really slow. Price decreases also rose this last week. They're not as high as they were about 3 weeks ago, but we ended up seeing that of those units that did go under contract, it was 47.8% of them decreased their price, 1.6% decided to increase their price, and 50.6% of all the homes remained unchanged in terms of their average sales price. The size of the price reduction also went up this week. We ended up shooting up from about a 5.9% 3% price reduction to a 6.6% price reduction this year or this week. And so we're looking at about a $46,500 off of that original price in order to get the home under contract. And keep in mind that the size of the price reduction varies depending on where your home is located and the price point that you're looking at. In the monthly reports that I put together, the attached and detached residential reports, there is a zip code map that shows you the likelihood of having to make a price reduction by zip code and the size of the price reduction by zip code. So make sure that you take a look at those reports as well. And if you need help analyzing what size of a price reduction to make, you can also reach out to me for that. And I can pull a report and analysis that shows price reductions by your area. Looking at homes at the $500,000, looking at our strategy sheet for the last week, we ended up seeing that it really cooled off in this under $500,000 market, and the odds of selling went down to their lowest that we've seen so far this year. But again, this is to be expected at this time of year. These shouldn't really come as surprises as we get into the fourth quarter, as we get more units that are fewer units that are going under contract right now. Average daily active count was up by about 1% with about 1,900 total homes available for sale. Pending transactions actually rose this last week by about 4.4%, bringing our month supply of inventory down by about 3.3% with 1.5 months worth of overall inventory. You can see that our expireds and withdrawns, expireds were actually up from this same week 1 year ago by about 7%. So we're seeing more of that purge, but withdrawn transactions are down 17.2%. So we're not seeing that inventory come off the market like what we've seen in years past. It drives our inventory down to historically low levels. The odds of selling in this market are higher and better than what we see on the overall market as an average at 50.9% week over week. That actually increased by 1.2%. So there was more market activity for those homes that were under $500,000. However, we are off from where we were 1 year ago by about 3.4%. This market is the most far market out of balance so far. When we look at the data points broken out into $500,000 price segments, the percent of balance was sitting at about 25.8% of balance. We would need to have about 7,500 homes available for sale in this market. Looking at shows per property per week, roughly 2 showings per property per week for homes that are under $500,000. So if you're not getting your 2 showings per property per week, maybe time to go through and consider a price reduction. In this market, we're looking at about 13 showings to go under contract. That actually came down this last weekend. So the buyer pool got a little bit more serious about putting homes under contract. Again, if you want to be moved in by Christmas, it's time to get under contract right now to put up your Christmas tree. So looking at about 13 showings to go under contract. So if you had 13 showings and no offers, time to reduce that price. Median days on market also stretched out again. I think that's fall break in there, but it was 19 median days on market this last week for homes under $500,000. Price decreases actually declined ever so slightly this last week. We saw 44.4% of the homes that went under contract last week ended up making price reductions. 1.9% increased their price and 53.8% remained unchanged. The size of the price reduction also went up in this market. We saw a 6.3% price reduction, or about $26,000 to $27,000 off of that original price. Looking at homes between 500 to $1 million, this is our largest price point. We're looking at 60.2% of the overall market. Looking at our strategy sheet from the last week, it wasn't as cool as it was back over Labor Day weekend, but the market is definitely starting to cool off as we head into this fourth quarter. The average daily active count remained relatively flat at about 3,800 homes that were available for sale. Pending transactions fell week over week by nearly 7% with only 389 units going under contract. Again, we're not seeing people come off the market like what we typically expect. And this purge of expired and withdrawn transactions is imperative in the fourth quarter because that's what drives our inventory down so low going into the first half of the year for January, February, and March. And that's really where we see the kickstart of appreciation that starts to happen, where we see our average sales prices going up month over month as we get into the fourth quarter, into the first quarter of the year. So it's important that we start to see some of these expired and withdrawn listings come off the market so that we can have that predictability going into the beginning of next year and see that price appreciation grow. Keep in mind that 95% of our appreciation is established between January and June, and And without this purge of expired and withdrawn transactions, we may not see that pop of appreciation that would start to happen into the first and second quarter of next year.
I've actually got some predictions in the second half of this presentation talking about the fact that we might not see that uptick until like say March because of this. Yeah.
So we could end up seeing that happen. Odds of selling remained relatively flat this week for 500 to $1 million at 43.2% overall odds of selling. This market is still out of balance as well. We only have about 38% of the inventory that we need to offset demand. We're looking at about 1.5 shows per property per week. That actually increased week over week by about 2.2%. We're looking at 14 showings to go under contract. And so again, tire kickers out there right now looking for the deal. And so if you've had a total of 14 showings and no offers, maybe time to consider a price reduction. But don't panic reduce your properties. It's not reducing your properties, your price at week number 2 on the market. Based off of median days on market, we're looking at 29 median days on market. So if you've been on the market for about a month and no offers, then it may be time to go through and reduce your price. Now in this market, we ended up seeing that price decreases increased week over week by 7.4%. We ended up seeing that more than half of the homes that went under contract last week had a price reduction. We're looking at about 51% of homes reducing their price, 1.3% increase their price, and 47.7% of all the homes made no change to their price whatsoever. Price reduction was also up pretty significantly this last week. We ended up seeing that the size of the price reduction jumped up to about a 6.6% price reduction, or about $50,000 off of the original price of that home. Once we go into the $1.1 to $1.5 million market, we're only looking at about 7.6% of our overall market at this point. Your target time frame in which to list these $1 to $1.5 million homes is typically getting into March and April are the reddest months of the year. September and October end up being some of the most challenging months for this particular market. Looking at where we are for a strategy sheet, we did come in with some of our lowest odds of selling as we got into the third week of October. We're looking at about 610 average daily active counts. And so that means that our average daily active count actually came down by about 2.7% week over week. We ended up seeing that our expired and withdrawn transactions are off by 35 to 45%. And so we're not seeing that big purge of expired and withdrawn transactions. So inventory is staying higher than what we've seen. And it's actually higher than where we were 1 year ago by about 10.3%. So there are more choices. This is a great time to be a move up home buyer if you are looking to move into that over $1 million segment right now. These people want to negotiate, bring them an offer, but our month supply of inventory ended up shooting up week over week by 22.3%. We ended up seeing that our predicted month supply of inventory came in at 4 months worth of overall inventory. And so that means that at the current rate of sales, it's going to take about 4 months to sell off the existing inventory right now. Looking at the odds of selling, it dropped by about 2.5% week over week. We're looking at about a 31.6% overall odds of selling. Looking at where we are in terms of balance, this market is trending closer towards balance than most of our other markets. We're at 44.5% of a balanced market right now. Shows per property per week, about 1.3 showings per property per week. We're hanging in there at about 775 total showings that are being set each week right now in this $1 to $1.5 million property. Shows to contract. So again, the tire kickers are out there. They're really out there looking for a deal. They want a deal. I can't stress that enough. They want a turnkey deal right now. $1 million is a lot to go out there and spend on a home. And if it's not in perfect turnkey condition, buyers are going through and they're passing over those homes right now. But based off of data from last week, it was 22 showings to go under contract, and that was up 24.6% from where we were 1 week ago. Looking at median days on market, this market is also at 29 median days on market. That is up week over week by about 28.9%. 47.1% of all the homes decreased their price, 2.9% increased their price, 50% remained unchanged whatsoever. Price reductions are also larger. We're looking at about $100,000 price reduction in this market, so about 7.8% off of that original price. 1.5 to 2 million target time frame really is February, March, and April for $1.5 to $2 million. Here's our strategy sheet. Again, bluest week so far, well, second bluest week so far as we look at our strategy sheet, only being beat out by Labor Day weekend. Looking at our average daily active count, it actually came down by about 2.5%. New listings were down 7.7%. Expireds were flat at 4 expired listings, 7 withdrawn listings in this particular price point. That was up 75%. So we are starting to see some of that purge, but look how much higher our inventory is this year versus where we were for the same week 1 year ago. We have 70.1% more inventory in this market than we did 1 year ago for $1.5 to $2 million. Looking at our month supply of inventory, we're now up to about a 5.3% or 5.3 months worth of overall inventory in this market. The odds of selling ended up declining week over week by about 6%. We were looking at about 20.8% for an overall odds of selling in the next 30-day period. In this market, we only have about 44.3% of a balanced market, so it is trending closer towards a balanced market. We're only looking at about 1 show per property per week in this market, and it's taking 23.6 showings to go under contract. So again, a lot of people out there looking, but they're not necessarily making moves on the properties right now. For median days on market, it came down week over week. So it was those newer listings that were getting picked up this week. They've seen all of the existing homes that are on the market. They're just waiting for that perfect home to come to market right now. But it was 28 median days on market for homes between 1.5 to 2 million. Whereas in the last 2 weeks, we had been trending upwards towards 60 to 80 median days on market in this $1.5 to $2 million mark. This week, we saw a sharp decline in price decreases. It was 33.3% made price decreases, no increases, and 66.7% remained unchanged. The price reductions were substantial in this market, $91,000 off of the original price to get it under contract, or about a 9.5% price reduction. Lots of questions out there, so I'm going to rapid fire go through these as quick as I can, and I'm going to escape out of this so that doesn't mess up yours. And let's see. So can you put that website in the chat, Megan, that you just mentioned? Yes, I will go ahead and type that into the chat for you as we get that going. As a reminder, it is ignitere.firstam.com. It seems like RE Colorado is trying to limit their data transparency by not allowing you to share it. Not necessarily. What they're trying to do is trying to prohibit people from going through and scraping their database, because all the power is in the data that they harness out there right now. And so being a data provider, there are so few of us that data feed comes at a significantly higher cost. And it also changes the way that I have to go through and access the data, which will allow me more flexibility in the future to try and create this information more quickly. Will the report download have past info or just that week's data? So it's going to create a library of that data in the website so that you can go back and look at those historically. And so the question was $10 per report per week. Yes. And so each report that I publish, there are 5 different reports that I publish, 6 different reports that I publish on a monthly basis. 4 weekly, 2 monthly, and then there's the appreciation map that I'm updating annually at this point. Each individual report is $10. Will there be a monthly subscription option by chance so we don't have to purchase each week? Unfortunately, we're not set up in a way that I can have a monthly subscription set up quite yet. That was my ideal situation when I was trying to put this together, but unfortunately, I have no way to set up a subscription right now, so it has to go in by week. What's a better weekend to list? The weekend before Thanksgiving or the weekend after? I would go for the weekend before Thanksgiving, because getting into the time between Christmas and New Year's really starts to slow down. So Megan, are you still going to do a weekly Thursday webinar on the report so we can have a general idea of what's happening without having to pay a fee to download the reports each week? Yes. And guess what? Take screenshots. So that you can grab that information if there's a graph in there that you really wanted to see. Can you please repeat the percentage of seller concessions in September that went to a buy down? So it was overall 60% of all the homes that closed in September had a concession. 40% of those went towards a rate buy down. I wish MLS had a field that would show sellers willing to do a rate buy down. Thoughts? Yes, I have provided that feedback to the MLS as part of a committee that I sit on. And so hopefully that's something that they end up offering in the future so that you can search for those that are offering a rate buy down. 2 weeks ago, my buyer lost out on a single family residential with lime green and orange walls. 6 other offers. It was an estate price to move at $397,000 sellers in Lakewood. A $397,000 home in Lakewood is a
good
steal.
It's a good
It is a
deal.
steal because Lakewood is on fire right now in terms of
Yeah.
the overall market.
And that's the truth, though. I mean,
Yeah.
you do see, and I'm talking to more and more, obviously buyers going in and putting offers on listings, and those listings, when they're coming in a deal, you're drumming up a ton of activity with that. All right. So as soon as Megan does that, we're going to start off talking about what's happening, what happened this morning with the market, what it means for you and your buyers when it comes to interest rates and affordability, and changing our mindset so that we continue to be the resource for them. Because right now we can't shut down, right? We have to continue to reach out to them to stay in flow. I've been talking with a lot of my agents about partnering up and either creating strategies one-on-one in where their vision is taking them, where they want to build their business. From the folks that I've been talking to, what ideas can we generate together in capitalizing on this market? We're also talking about creative strategies to keep you in flow. It's the holidays. How do we pull people together? How do we have economic and housing sit downs? How do we talk about where the market is going? And how do we personalize that experience for them? Because right now they're getting bombarded and flooded by headlines. How do we just make it real without the fear, right? And just personalize the opportunity? Because whether they get in today or whether they get in next year, especially first-time home buyers, this fourth quarter is the time they should be getting in, if they can, right? Because some people can't, and I get that. And we're going to actually show some affordability numbers here in just a second. So let me share the screen and make sure that we get you guys out of here on time. All right. All right. Here we go. So let's start talking, right? Here we are. We've got tons of opportunities, the beginning. And I want you guys thinking about this as a beginning for where you're going. What is your 2024 going to look like? At the end, we're going to be talking about, obviously, we've got our Agent Ignite in November is always about goal setting. Justin Knoll, who's a dear friend of mine, is going to be doing that with me. And we're really going to be centered on what is the vision that you want to carry your business into 2024. How do you want to retool, rethink where that's going to take advantage of opportunities that are in this market? Because you're going to see 2024 is going to slow down. 2025 is going to start to pick up and look like 2023. And then we're going to start to build from there. Are you taking advantage of this time that by some measure might be slower to double down on your business and get creative? What are you building? Is it a business that's going to be sustainable for the next decade, given the opportunities that we know that we still have a ton of folks who want to get into home ownership? So let's dive in. If you guys have not signed up for the text updates, you need to make sure that you're doing that. That goes out every Friday. And we're talking about where the rates are going or what economic data came out. If we did not have this market update today, we would have sent out a text because we had 3 whammies come out this morning showing how strong the economy is. And I want to paint those reports and actually show you what's underneath them so that you can have realistic conversations with your buyers, with your sellers, talking about what are we looking at going into the end of this year and going into the beginning of 2024. So this morning, the GDP report came out more than double what it was last quarter. So this is first look.
What?
I can't make this shit up. I can't make this
happening.
So GDP came out almost 5% for the quarter. Now, this is first look. Remember, GDP actually has 3 looks. It's the most random report. It's the only report that has 3 looks. This is the first look. And it's strong consumer and government spending. We know the government is spending right now, but so is the wealthy consumer. The 80% of income earners in America right now have tapped out of their savings, those reserve savings that they had from the pandemic. But the top 20% have not. You also have retired Americans who just got a raise. They got a massive push up in Social Security income. And now on top of that, all their fixed income is all gone up, right? Because the short-term rates have gone up. So now the money market interest rates that they were getting or the short-term interest rates that they were getting has all gone up in addition to Social Security. So you have the older generation and you have the wealthier generation that's all propagating this continued strength. Yet, Real disposable income, and the word real means inflation adjusted, real disposable income dropped 1% versus last quarter. It actually increased 3.5. So there's actually some discrepancy. We have this spending that's happening, but real disposable income has actually gone down. So this is not going to be like, we're not going to have 5% this quarter and the next quarter is going to be 5 or 8. I mean, we're not going to have this massive continued growth, but this is saying that the third quarter was an interesting quarter where we did have people spending a lot of money, but not making as much and working through their spending, which we know because credit card balances were up. Right. So this makes a lot of sense. Personal savings dropped from 5.2% in the second quarter to 3.8% in the third quarter. Initial jobless claims just came out this morning, up barely anything, up 10,000. But when I look at a 4-week average, it's flat. Initial jobless claims, we're not seeing massive layoffs. We're seeing that once people are on unemployment, though, they're staying on unemployment right now. For all of those job openings that we supposedly have because of the JOLTS report, we're not actually seeing that people are quickly able to get off unemployment and back into their new job. But that was 2 of the reports. The third report was durable goods. Durable goods came out up 4.7% compared to last month where it was 1.7. I don't even understand that. So it's again more than double. Durable goods, people are spending a ton of money. Now, there was a massive airplane orders, Boeing was way up, but you've got durable goods, those big ticket items that you hold on to for a period of time, like refrigerators, washer and dryers, that were all up 4.7%. So people are spending. They've outspent their savings is going down. They've started to put it on credit cards, and the top 20% have seen incredible wealth gain through the stock market, through fixed income, short-term rates going up. And then you've got those who are retired getting raises. So people are still spending. So the question is will we have a recession? Because we very well might not.
I don't think we are.
I don't think we are either.
I don't think we are.
And the recession was the very thing that we were hanging on to in order to have that uninverted yield curve, in order to have interest rates start dropping, right? As a mortgage industry, we wanted the recession, but the America is just too strong. Our consumers continue to spend. So this uninverted yield curve, because we've been working with an inverted yield curve, remember short-term interest rates versus long-term interest rates, I should have to pay more in interest for long-term rates because you're holding my money for longer. It's got a longer risk. And it's so I need to pay more for that. Or as an investor, I need to make more for that. Really, more importantly, because that's how the bond market is moving right now. This yield curve, which has been uninverted since 2022, is now starting to uninvert, but for the wrong reason. It's actually the long-term rates that are continuing to go up, which now they're calling a bear steepening, which is this rise in long-term rates, which is going to continue to keep our rates at that 8-ish%, maybe a little higher, right? While we're adjusting into this no recession period of time. Obviously impacting consumers, businesses with a higher cost of everything, mortgage rates, and will have continued long-term lagging effects. So we've got this 10-year right now is sitting just under 5%. The 2-year is just over 5%. Now the 2-year is tied to the Fed rate. It's tied to all the short-term rates. I was having a conversation with a buyer yesterday. We were talking about this, who was getting a HELOC, wanted to lock it in, got really scared about the variability. I'm like, no. Whatever you do, don't lock in the HELOCs now. We're at the top. The Federal Reserve is going to come out on November 1st. They're probably not, although we had some strong economic data, but even if they raise the Fed rate, it will be one more time. So if you've got the Fed rate up possibly one more quarter, you don't want to lock in those HELOCs at the top. They're going to start coming down next year. So ride that train all the way back down again. Don't lock in the HELOCs. But for the short term, you're going to see these long-term interest rates continuing to go up since the short-term interest rates are tied to the Fed and the Fed rate is staying higher for longer. So as we know, the 2-year and 10-year is going to start to uninvert. The 10-year is going to go higher. The 10-year treasury is tied to the 30-year fixed. So we're going to see that 30-year fixed. The biggest play we have right now is this spread. We are still sitting at 3% spread. If anything, it's going to be the spread that comes down, dropping our interest rates going into next year.
Okay.
That's what we're watching for. All right, so Goldman just dropped their housing market this week for 2024. Last week, if you were with us at Agent Ignite, we talked about a couple of other people that dropped their housing forecasts, and that was Fannie Mae and Mortgage Bankers Association, MBA. Goldman Sachs just dropped theirs this week, talking about that the housing market is going to continue to see high home prices. We're not going to see a bubble burst. We're not going to see home prices go down. So let's look at what that what that looks like. Existing home sales, they're actually saying in 2024, we're going to see 3.8 million, which is down. Really, 4 million is the baseline. Wow. And that's United States wide, right?
Okay.
So we're talking about that 4 million is really we saw much higher numbers in the last couple of years. It was 5, and before the year before that, it was 6. Yeah, no, it wasn't.
It's not fair.
But 4 million is really kind of your normalized baseline. So we're going to go lower. But if you look at that, we're going to actually see higher housing starts going into the next couple of years in new home sales. So new home sales is actually going to go up from 680 to 723 versus the existing home sales are going to come down. So we're going to see offset, existing home sales coming down, offset by new home sales. The 10-year treasury is expected to be at 4.3 at the end of the fourth quarter. Remember, 4.3% on the 10-year treasury. Right now, I have a 3% spread. So that is 7.3 at the end of 2024. If the spread holds true. So we could see volatile rates through the 7s all next year, possibly the very high 6s. They're also seeing a 1.3% appreciation for next year, which is really relatively flat, just given the market, which makes sense.
Yeah.
But remember, you're talking about 1.3% on a $500,000, $600,000, $700,000 home, not the 5% you put down. You're still going to get better returns than you would if you put that money in the stock market. New home sales came out this week. They were actually up 34% year over year. That is not a surprise to anybody listening to this. That is not a surprise. The new home builders right now are taking advantage of market share. So with the 2-1 buy downs, with the fact that they could drop in interest rates with the forward commitments, they're trying to take advantage of a locked up inventory. Single family starts were actually up 9% year over year. So we're seeing builders take advantage of this by starting up more single family homes. And Goldman Sachs even noted, he said, despite the 3.5% increase in interest rates, we have a 5% greater housing starts than we did in 2019. So we're continuing to see that. But if you look from 2012 to 2019, and you can look at this, you see new home sales actually were tough. They were down compared to years before the Great Recession. So we very well could be going back to before 2008 with our new home sales, depending on how many homes become available and how many continue to be locked up. They go on to say, Goldman does, that new home activity is much less sensitive to mortgage rates, specifically when housing markets are tight. We have a 0.7% vacancy in the United States.
That's wild.
It's nothing. We have no vacant homes. This whole ghost inventory was such a conversation in 2008.
Right? No,
it's just not a thing right now. So everybody thought that as the interest rates would go up, builders would be at great risk. Right now, they're taking advantage of the fact that inventory is locked up and we have no vacancy. Now they're trying to move inventory just like everybody else is, but they get to be creative because they own kind of the whole pipeline at that point. Existing homes are going to continue to be locked up with 90% of all mortgages locked. When I thought about it from this perspective, we talk about the fact that 90% of all mortgages are locked up under 6%. That's 2% lower than where we are today. That's a big drop. So we're sitting at really close to 8%. Most homes are locked up 2% lower than where we are today. They're just not going to release as well as we want, which is going into why we're expecting lower transaction counts next year than this year. So the strong economy continues to bump up. We saw that the 10-year treasury almost went right to 5%, but what we're seeing is it's hitting a ceiling at 5%. So it keeps going right up to it and bounce down a little bit, going right up to it. So we'll see. The news this morning didn't cause it to go over 5% because of all of those underlying factors that you had. The real income, the disposable income is low, that it's just certain groups that are spending all of this money. And even in durable goods, because so much of that was tied up to Boeing and airplanes, that when you start peeling back the layers of that onion, We're seeing that we're not seeing that 10-year treasury jump, but we're seeing it sit right about 5, which is causing our 30-year fixed rates to stay right about 8%. In fact, they started to pop up right there, but they're sitting right there and not really going over very fast, which is good. So all of this plays into the fact that we have hit historically low housing affordability. That's not a surprise to anybody.
No.
That's not a surprise to anybody.
Nope, not a fun number.
It's not a fun number, but it's a conversation that we need to be having in a very real way, talking to our clients, saying, I understand that this is where we're at. What are the opportunities that are beyond that? Because I'm going to show you in a chart in a minute that do they know where home prices are going? So Denver's required income to afford a home compared to 2020 January is up 131%.
Yeah.
So compared to January 2020, so pre-pandemic to now. So really quickly, just taking median prices from January 2020, median prices from January 2023, and median home prices for the Denver Metro this month, based on a 20% down at the interest rates that we have going on right now, there's your P&I payments. And that minimum wage number is how much it would take to afford that P&I payment at 30%. And I put it at 30% because the taxes and the insurance aren't in there. And of course, you've got car payments, student loan payments, and other household debts. So I kept it at 30% to be realistic. And there's the average wages for the Denver Metro right now. So far year to date, we've had a 2.4% increase in wages, which just does not cut it. Our average wages are not covering the minimum wage that you need to become a home buyer, which is why we're continuing to see, if I look nationwide, that difference isn't 130%, it's 50%, which is why we're going to continue to see this migration due to affordability, right? So many people right now talking to me about where can I go and make my money work for me? And we're talking about very specific metros in very specific states, as far as where's cash flow relative to purchase price, a win. Because there are still places where that is. Now, I can honestly say that nowhere across the United States is it cheaper to buy than rent. But I can say that especially if you're looking at creative investing and creative financing, there are opportunities outside of Colorado or even outside of the Denver Metro where you can still invest in a home and have appreciation opportunities. All right, don't give up. That's the bottom line, that there are winners in every market. Don't get right there. Don't get right there and give up. Guys, 2024 is going to present both challenges and opportunities. So how do we lean into the challenges, looking for the continued opportunities? This is our job right now, to stay in flow with our clients, helping them find those opportunities, helping them find the deals in the fourth quarter, because this is the quarter to find them. Don't turn around, get more aggressive, be more specific on what you're trying to achieve, and go after it. Because do they know that even if we see some price declines at the end of this year and the very beginning of next year, that is expected nationwide to continue going up as early as March, right? So sitting on the sidelines waiting for the bubble to burst is not going to happen anywhere. It's not going to happen because we are so limited in our overall inventory, not compared to the last 2 years, compared to all the normalized years, that we're still fighting to find that right home or that best deal. So because of low inventory, we're going to continue to see home prices continue to go up. If they don't take advantage of the deals operate or give into them right now in the fourth quarter, they're going to go back into a multiple bid situation in the spring. So help them know their budget and help them know their options. And of course, in the Tuesday Live this week, we talked all about creative loan financing and buyers and sellers beware. It's not about don't do it. Just know what the options and the risks and the pros and cons are. Same with first-time home buyers right now. First-time home buyers, investors, and buyers who have cash are our opportunity right now. They're the winners in this market. Knowing how to speak to them, to their budget, to their long-term vision and goals, and fitting in real estate to help them achieve that is the win. Talking about interest rates and home prices is not the win. It's just not the win, because I'm going to stop you right there. I'm not interested. So that's why Justin and I are getting together for Agent Ignite for November, because we talked about that. We're doing the goal setting this time. So we're actually not going to be doing a deep dive into the market trends. We're going to touch a little bit about what the market is giving us at that time. But then Justin and I are going to be talking about casting that vision so strong, it creates itself. What do you want for 2024? What kind of business do you want to run? What do you want to achieve? How many people do you want to impact? Of course, it's in our office, so space is limited. So make sure to sign up, and then make sure to cancel if something comes up, and give our folks on the waiting list. We had a packed house last time.
That's so great. I love it.
I loved seeing that. We had a couple of people that couldn't do it at the last minute. The waiting list filled it right back up again, and it was so fun. And then do make sure to take advantage of the next big thing. We've got so many people looking towards our future, not looking back at what was or what might have been, but what is, and the opportunities presented in this market, and how to strategically take advantage of those. So I'm going to stop share. We got just a couple questions. We can, right there is how I do it. Figured it out.
Where do we go?
This one is yours. Do you know the percentage of transactions with concessions in March or April?
I don't. I don't. I would have to go back and look that number up. Shoot me an email, maller@firstam.com.
Sounds good. What's the best time for 625 to go on the market?
So the highest and best odds of selling that ended up happening was the weekend directly following Easter weekend.
I remember that vividly.
Yes.
Yeah. How do you think the current situation in Israel and increasing interest rates affects the market, coupled with the coming election?
So election years have no bearing on what happens in the real estate market.
None.
I went back 4 real estate cycles trying to prove something, and there's really nothing that ends up happening other than people using it as an excuse. And so it really doesn't change what the course of the market is going to be doing. What do you think about Israel?
I did that whole chart showing both interest rates and appreciation by year.
Yeah.
Nothing. It had nothing to do with it.
Nothing.
And of course, the conflict in the Middle East is going to impact the sense of stability, I think. And of course, we just found a speaker for the House. That's good news. And then we have this upcoming government shutdown. So there's a lot going on right now that will continue to create a little bit of a fear and that flight to safety. But we haven't seen that as much raise interest rates as we have just simply the requirement for investors to make more money on their long-term risk.
Just an update from Kara on Nicole's team. If you are texting into the rate update line, just text update. Okay. Yeah. So that's only update. Don't put anything else in there.
Thank you, Kara.
Would you lock a HELOC today with a 12-month promotional rate?
It depends on how low the promotional rate is. You got to remember that if you look at the CME Fed rate tool, it's watching where the investors think the Fed rate's going to go. They start to think that the Fed is going to drop the Fed rate by a quarter and maybe even 0.5 starting in June or July. So it really just depends on how much lower is that promotional rate versus waiting a year. Are you going to be stuck there if the Fed rate does start to come down?
Is the expectation of a slower, lower transaction count in 2024 backed by any data? If so, what data?
I mean, that data is backed by the percentage of the existing homes that are locked up with low interest rates, right? And the ability for builders to try to keep up, but not meet demand. So that's what they're talking about. The low transaction count is because you have locked up existing homes. So if you don't have sellers who are then putting their house in the market, you don't have sellers that are converting to buyers, and you don't have anything for those first-time home buyers to buy.
So buying more expensive than renting doesn't consider tax benefits, appreciation, equity earned. That's a very true statement.
100%.
Yep, you are absolutely
I am a big champion.
Right on there. We have a request to go back to the slide showing affordability comparison in 2020 to 2023. We are going to be posting the slides in the Agent Ignite update, and I will be emailing out my slides here in about an hour.
Yep.
So you'll get a copy of all that. What is the current HELOC rate for A credit borrowers?
So the prime rate is 8.5. So, the prime A would get the prime rate, and then your bank is going to determine based on risk. You might get prime plus something or prime minus something. I've talked to people where they have 10, 10.5, even 11, depending on their situation.
Awesome.
Yeah.
Well, that takes us through all of our questions.
Fantastic.
I did get Nicole a going away present since I won't be able to do this with her anymore. All right. This is the way to go out.
Yes, we drink tequila. We know that. We know that. You guys, this has been a blast. I know we went a couple minutes over, but as we continue to expand the education and the opportunities that we're providing, make sure that you're getting both of our emails. If you're not, make sure to reach out to us. I know that we're going to continue to put out content. We're going to continue to put out information, knowledge sharing, and access. You guys reach out to either one of us. We would love to support you to support your buyers and sellers, because right now the power of real estate is bigger than anything else, but it's being clouded by fear, and we have to break through that.
Awesome. Well, it has been a pleasure
Yes,
these
it has.
last 3 years. So thank you for all of your
Yes.
contributions. And I so
You're welcome.
appreciate your friendship. And
Agreed.
so we will continue to put together things in the future that will
Yes.
be in person. So we hope that you guys come out to those. Otherwise, please keep us in mind for your next transaction. And we hope to see you guys at our closing tables soon.
Absolutely.
Have a
Take
great
care.
rest of your week. Bye.
Signing off.